Modern financial markets produce a continuous, high-frequency stream of price updates. Every second, thousands of transactions are broadcast to a global network of monitors. To organize this data, most analysts use a standard framework. They plot price on a vertical axis against a constant progression of time on the horizontal axis. This creates a structural inefficiency. When a market moves sideways, time continues to pass. The chart records a long string of identical handles, filling the screen with information that doesn't actually signal a change in price. If we remove the horizontal axis, those redundant periods collapse. All the sideways movement is compressed into a single vertical stack, showing only the price changes that actually occurred. Since time does not create support or resistance levels, filtering it out allows a trader to focus strictly on the interaction of supply and demand. The point-and-figure method is a mechanical, dimensionless approach to charting. It ignores time entirely to isolate the underlying trend. This chart compares the exact same market period for the S&P 500 index. On the left is a standard daily bar chart. On the right is the point-and-figure equivalent. The bar chart on the left contains erratic spikes and false breakouts, making it difficult to pinpoint exactly where buyers and sellers are most active. On the right, the point-and-figure chart clarifies the trend through alternating columns of X's and O's. To understand how the system generates its signals, we have to look at how these columns are built from raw price data. Internalizing this format provides a framework for identifying price targets that are derived directly from the chart's own geometric structure. Here is a sequence of intraday trading data for a Swiss franc futures contract. Each number represents a sequential price change over a 9-day period. Construction follows two primary rules. Columns of X's record rising prices, and columns of O's record falling prices. We must also define a box size. This is the minimum price move required to make a mark, for example, 5 points. Any fluctuation smaller than 5 points is ignored. We start by placing a dot at 4875. When the next price is 4880, a 5-point rise, we fill in the next box up with an X. The one-box reversal rule states a new column only starts when price moves against the current trend by one box. When data drops to 4860, the chart shifts right, filling O's downward to record the reversal. This one-box chart serves as a high-resolution view of the market, tracking significant intraday fluctuations to show where a contract is accumulated or distributed. While sensitive, the one-box chart can become cluttered. This grid of a Deutschmark contract captures a high volume of minor fluctuations that can obscure the primary trend. To solve this, we can adjust the sensitivity by increasing the reversal criteria to a 3-box requirement. In a 3-box reversal, the market must move against the current trend by exactly 3 times the box size before we start a new column. Any smaller reaction is filtered out. By moving from a 1-box to a 3-box or 5-box reversal, we compress the data significantly. These condensed charts remove minor price reactions, preserving only the dominant structural moves of the market. This leads to the Chartcraft method, simplifying the process by using only daily high and low prices to determine if a column continues or reverses. Adjusting these parameters allows the analyst to tune out short-term volatility and focus on the underlying market vector. Because point-and-figure charts are restricted to a uniform grid, they generate binary signals for buying and selling. A buy signal occurs at the exact moment a column of X's rises 1 box above the peak of the previous X column, as shown by these arrows. On a bar chart, trend lines are often subjective, connecting different sets of lows depending on the analyst. Point-and-figure charting uses a purely mechanical rule. These examples show how trend lines are drawn at rigid 45-degree angles. A bullish support line is drawn upward to the right, originating from beneath the lowest column of O's in a pattern. As long as the price holds above this geometric boundary, the macro trend remains intact, replacing personal bias with a consistent rule-based measurement. This system also offers a way to forecast price objectives. It is based on the premise that the width of a congestion area is directly related to the distance of the subsequent move. This British Telecom chart shows a horizontal count across the base. Counting columns and multiplying by the reversal value projects a specific upside target. On the right, the vertical count measures the first breakout column, multiplying by 3 to project the upward distance. This geometry treats market consolidation like a coiled spring. The wider the horizontal compression, the more energy is available for the eventual move. While identifying targets is useful, risk management is what determines long-term survival in the markets. Point and figure charts provide a framework for dynamic trailing stops. In an uptrend, a protective stop can be placed exactly one box below the most recent column of O's. Minor 2-box corrections will not reach this level, allowing the trader to stay in a position during normal market fluctuations. A full 3-box reversal breaking below the previous O column indicates a trend shift, triggering a mechanical exit. This mechanism enforces discipline by requiring an exit at a predefined geometric level, rather than letting fear or hope dictate the decision. We have moved from a chaotic, time-based view of the market to a uniform matrix that focuses strictly on price action. This comparison illustrates the difference between viewing time as a primary variable and viewing price as the only variable that generates profit. The visual noise and false starts of the left chart are resolved by the structural clarity of the point and figure grid on the right. Point and figure functions as a mechanical filter, prioritizing price action over the passage of time, focusing on the core dynamics of supply and demand.